The pandemic-led economic crisis represents a real litmus test for the banks. The credit growth of the banking sector is likely to nosedive to a multi-decade low of 0 to 1% in the current fiscal year, as per the ratings agency CRISIL. And now, amidst this gloomy scenario, HDFC Bank shines bright, shrugging off the growth concerns by reporting strong earnings growth of 20% in Q1 of FY21. In our ideas for profit today, I'll discuss whether the robust performance in Q1 makes it a clear outlier in this sector. Well, the Q1 performance pleasantly surprised many, given the weak economic or the macroeconomic backdrop. Now, HDFC Bank's loan growth of 21% and deposit growth of 25% as at the end of June is way above the industry loan growth of around 6% and deposit growth of around 11%, indicating that the bank is gaining market share at an accelerated pace, notwithstanding the huge size that it has, with a balance sheet of above 15.5 lakh crore rupees amidst the economic slowdown. Now, HDFC Bank's Q1 performance of the bank actually reaffirms the pandemic shock will make HDFC Bank even mightier, as it stands to benefit from the flight to safety in an uncertain time, also triggered by Yes Bank saga. Now, loan growth in Q1 was driven by the corporate loans, while retail lending book actually decelerated. HDFC Bank reported total advances of 10 lakh crore rupees as at the end of March, which is an increase of 21% over last year. Growth in deposits was robust at 25% year-on-year, with the deposits and low CASA deposits grew by 26% year-on-year, while the time deposits were also growing about 24% on a year-on-year basis. The net interest margins came in at 4.3%. Now, the key driver of the bank's profitability has been the improvement in the operating efficiency. The gross non-performing assets ratio stood at 1.36% of the advances. The lender also created a COVID-19 related contingent provision of 1,000 crore rupees, and one of the concerns which includes is the bank's retail loan book is skewed in the favor of unsecured products, and the share of unsecured loans stand at around 17% of the bank's total loan book at the end of June, which is higher than most of the peers. Now, the performance of this book remains a key monitorable even going forward from here. However, the management clarified that the chunk of the wholesale lending is towards the top corporate or top rated corporates. Now, HDFC Bank is also gaining market share from, say, PSU banks that are saddled with NPAs, and also from the private sector banks, say Yes Bank as well. Now, however, FY21 earnings may be impacted due to the higher provisions or maybe the lower revenues also. The bank has already disclosed the size of its moratorium book, putting to rest all kind of speculations. We are actually enthused by the fact that the size of HDFC Bank's moratorium book at 9% of the total loan book is lower than its peers. Now, the bank's total loan growth continues to be very strong. The margins are steady, asset quality is stable, and also the capital is well above the regulatory requirement as well. So these are the key positives that we are focusing on. Now, moreover, the bank has a contingent provision of, say, 5,400 crore rupees, which includes a floating provision of about 1,450 crore rupees, which is very comforting. Also, we see the HDFC Bank's churning profitable growth over the next few years as well. Now, the banks, while the banks may be impacted by FY21 earnings due to COVID-19, the outbreak does not impair the bank's long-term earning potential for sure. Now, the bank's valuation has fallen, while the long-term growth and profitability outlook also still remains very strong. The bank is trading at 3 times core book value estimated for, say, FY22, assuming a conservative earnings growth of, say, 13% CAGR over the next 2 years. Now, given the return of assets at 2% and return on equity of around 16 to 19%, the valuation can definitely revert to the historical mean levels, which along with the earnings growth can lead to a reasonably good upside in the stock price in the medium to long term. Now, given the stellar performance already and the high probability of the valuations also getting re-rated, HDFC Bank looks to be a must-buy stock and should form part of the every investor's core portfolio as well.